Are you curious as to what you can and cannot write off on your taxes when it comes to real estate? Well, if you are, make sure you stay tuned to this episode of Morning Cup of Real Tea. Welcome, everybody, to this episode of Morning Cup of Real Tea. We're going to be talking about taxes today and how it applies, or how real estate applies to your taxes, what you can deduct and what you cannot deduct on your federal taxes. And if you have specific questions, you can ask me, but I'm most likely going to defer you to a tax advisor or your accountant because they're going to be the ones that have all that information readily available and be able to answer it really quickly. But I'm going to hit on some of the things that I know that you cannot deduct and things that you can deduct. So let's start off by talking about some of the things that you cannot deduct. So things like fire insurance or homeowners insurance premiums, you cannot deduct those things. I know homeowners insurance premiums are going up. You wish you could, it would be nice, but you cannot deduct those premiums. Your principal amount on your mortgage, not deductible. There are certain things about your mortgage that you can deduct that we'll talk about here in just a second, but other things like depreciation, utilities, and your down payment. If you just bought a house, you cannot deduct the down payment that you made on the house. Okay. So that's a short list of things that you cannot deduct on your federal taxes. There's probably more to it, but those are the ones that are most common that I get asked questions about. um, so things that are deductible, and let me explain what this means. When I say things are deductible, you have so if you're familiar with taxes at all, you have your standard deduction, which currently right now the standard deduction if you're filing single is $12,950 for the 2022 tax year. If you're married filing jointly, it's $25,900. So what that means, and then I guess the only other one here is head of household is $19,400. So what does that mean? So you have your standard deduction, which is here, and then so you can either take the standard deduction on your taxes, or you can itemize all the little deductions that you're allowed to. And if those add up to more than the standard deduction, well, you take the itemized deductions. If they only add up to less, then you take the standard deduction. So here's some things as far as real estate goes to what you can deduct on your taxes. And again, if it adds up to more than the standard deduction, then you're going to end up itemizing. If you're only taking the standard deduction, none of these things really apply because you're just taking the standard, but it's still good to know what you can deduct on your taxes. So the first one is going to be mortgage interest. So if you're paying an interest rate, which I don't know anybody who gets a house with no interest. It's not like a credit card where you have 0% APR for the next year and a half and then you start paying interest. No, everybody that I know that has bought a house and got a loan, they're paying interest on that loan. So that interest you can write off on your taxes. Home, if you have a HELOC or some sort of home equity line of credit, you can write off that interest as well, but there is one catch. You have to have used that money to make home improvements. Okay. So let me reiterate, if you're using the money to make home improvements to your home off of a HELOC, you are allowed to write that interest off or deduct that interest on your taxes. If you're using that money to, let's say, for an investment, you're buying a second home or a rental home, you cannot deduct that interest on your taxes. And there's probably some more caveats to that, but just, putting it in black and white, you can write it off with that particular stipulation. It has to be used towards home improvements. Now, if you just recently bought a home and then you got a loan, and let's say you had to buy down your interest rate. Interest rates are really, they're still high right now. They're right about 3%. And um, it's so you get your interest rate, and usually most lenders will give you the option to buy down that rate. So you're going to pay a set amount. Let's say to buy it down 1 point or 1 percentage point is what that means. Might cost you $2,000, $3,000. Who knows? It depends on the lender. It depends on what they're charging at that particular time. But whatever whatever it costs you to buy down that rate, you can then use that as part of your deductions on your itemized deductions on your taxes. Okay, so the next one is going to be property taxes. So yes, you can actually deduct or write off or expense your property taxes. Now there is a catch, is it is capped. So if you're married and filing jointly, it's capped at $10,000. If you're filing single, it's capped at $5,000. And I'm not sure what it is for head of household if it changes during that. I don't have those notes, but either way, just know that it's capped at either 10,000 or $5,000, depending on how you are filing. Um, Necessary home improvements. So let's say you bought a house, and there, there's some things that have to be done, such as maybe you need to make it more accessible because or wheelchair accessible or accessible. You have to widen the door frames and things like that. The money spent going towards those types of home improvements are tax deductible. If you're just going in and you're upgrading your kitchen, nope, can't write that off. If you have a perfectly fine and working kitchen and you decided you wanted to upgrade it, that is not a tax deductible expense. Next thing is going to be mortgage insurance. So if you happen to have like a loan where you paid less than the 20% down, chances are you're going to have some sort of private mortgage insurance. That amount, and it ranges anywhere. I've seen it as low as like $50 or $60 a month, all the way up to like $150 a month. So, but that amount is tax deductible. So that is another one that you can put in there. Capital gains tax is sort of a weird one. So capital gains tax, if you own a second home, you're going to pay capital gains unless you do something that's called a 1031 exchange. But other than that, for your primary home, you can actually defer or not pay capital gains tax. So what that means, let's say you bought a house right before COVID, and let's say you paid $200,000. Okay, and then going through COVID, we all know that prices went up like crazy. Let's say you turn around and you sell this house for $350,000. You bought it for 200, you're selling it for 350. You have a profit in there of $150,000. Normally, if you don't meet these criteria, you would have to pay taxes, capital gains taxes on that $150,000. The catch, or not the catch, but the break point is if you lived in the house for 2 years consecutive in the past 5 years. You don't have to have lived in the house for 5 years, but in the past 5 years, if you've lived in the house for 2 years consecutively, those capital gains you do not have to pay. There are some caps on that, and they get pretty high. If you're wondering what those caps are, talk to your tax advisor. That'll be the easiest thing. They'll be able to walk you through whether or not you do have to pay tax or you don't. But just know if you've lived in the house for the past 2 years or in the past 5 years, 2 years consecutively, then you don't have to pay those capital gains tax. Okay, so that's sort of, I want to transition to something else here, and it is still relating to taxes, but I'm going to hit on it. In talking about your home office, I get this question quite often about whether or not you can tax deduct or write off your home office on your expenses and your taxes. The answer is yes and no. And it depends on your situation. So you can write it, or let me tell you when you cannot write it off. So over COVID, through COVID, the past couple of years, we've had a lot of businesses tell their employees that, hey, we're shutting down the brick and mortar store. you can go home and work from home, set up a computer, a camera, all that stuff, but you're still working for that employer. You're a W-2 employee. Um, you're getting a salary, things like that. You cannot write off your home office. You might have a home office, but as far as the IRS is concerned, you do not have a home office. The only time you can write that off is if you are a independent contractor, you're a sole proprietor, basically you own your own business. So if you own your own business, you're working for yourself, you get 1099s at the end of the year from people that you've done work for, or that you've made income from over, $600. Typically, they're supposed to send you a 1099. Then you can start thinking about your home office. Now, you can't just use your home office once or twice through the year and say it's a home office. It has to be used on a regular basis. And then the other catch is it has to be 100% used for that business. You cannot have mixed use for that particular office. So, for example, let's say, well, during the daytime, I use this room as my office, and I do all my work out of here. And then at nighttime, well, we use it as a game room. Well, that's mixed use. It has to be 100% used as an office. So the room I'm in right now is about 100 square feet, and I use it strictly for real estate business. So when I come in here, I'm coming in here to go to work. There's no personal things in here. It's all related to my business, everything from the cameras and the microphones, the computer. This whole area is my home office, and I get a 1099 at the end of the year. So the IRS says, yes, you can deduct that on your taxes. So how do you do that? There's some calculations that are involved. So for the example that I was giving you, let's say this room is 100 square feet, and to keep it simple, let's say my house is 2,000 square feet. So 100 divided by 2,000 gives you 5%. So what that means is 5% of my house is my office. All the expenses that I have, I can deduct up to 5% of those expenses. So I have a mortgage payment on the house, so 5% of that, utilities, interest, internet, everything that you're using in the house, you can deduct for your business and your home office. Again, it's a little bit more complicated than just that, but you should talk to your tax advisor to know for sure whether or not you can deduct your home office. Well, that is all for this morning's morning cup of real tea. I hope you enjoyed it, and I will see you at the next one.